that break. Glad you're still watching Science Breakfast with me, Alan Hubbard. A sign language interpreter this morning is Chabi Ward. In studio, we are with Mr. David Gitau. He is the COO of Lofty Coban, and we are talking about capital preservation in the Money Matters segment today. Mr. David, before we went for the break, I had posed a question around understanding money market funds and what they really are. And the most confusing thing is that a bank also has its own money market fund. How can investors and people who are wanting to start into investment create or basically get to know what to do and how to go about it?
Okay. I think, Alan, the key thing that people must appreciate is that first, you can invest directly into any investment. It doesn't really matter. You can go to the bank and discuss with the bank directly in terms of deposits. You can lend to government short-term through treasury bills by opening an account with central bank. You can buy shares directly. You can buy property directly. You can do rentals directly. So that is one route. And the second route is you can either go direct, or the second route is you go through a collective investment scheme. So essentially, what people must appreciate is that any company can actually decide, if they are confident enough that they can bring investors together into a pool of money or into a pool, any entity can actually initiate the formation of that collective investment scheme. And we call those entities either the sponsor or the founder. So that founder or that sponsor could be any entity. It could be a bank, it could be an insurance company, it could be an investment company like Lofty Coban. It really doesn't matter. What people must appreciate is that irrespective of the founder, that collective investment scheme remains a separate entity from the founder. Okay? And these collective investment schemes can actually be formed as either a trust, a partnership, or a company. But people must realize that this collective investment scheme is simply a vehicle to access certain investments, because people come together to achieve essentially two objectives. One, they're able to do bigger things that they would not ordinarily be able to do by themselves. And of course, with more money, there is higher negotiating power. So any entity, be it a bank, be it even Science TV, if they are confident enough, can initiate the formation of this collective investment scheme. Now, these collective investment schemes, like currently we have about, like as at March, we had about 496 billion Kenya shillings invested through these collective investment schemes. When you go to countries like South Africa, as at 2023, you have the equivalent of 21 trillion Kenya shillings. Why? The question should be, why are these collective investment schemes very popular? One, because people are concerned with the safety of their cash. Okay, that their cash is used for the right purpose and will not go and line somebody else's pocket. And what is common about all these collective investment schemes is the way they are structured, irrespective of the founder or the sponsor. So all of them, we must appreciate, they are all the same. We have, of course, the regulator who is in charge of registering these schemes. But within the corporate structure of this collective investment scheme, the most important service provider there would be the trustee, because they're the ones who are holding the assets in trust for the investors. They're the ones who actually look out for the investors.
The interest of the investor.
Then, of course, you have other service providers to ensure that the people's money is safe. You have the trustee, then you have the custodian. The custodian simply acts as a cashier. They're the ones who collect money on behalf of the trust or the partnership or the company. And I'll use the example of a trust because that is the predominant structure in fact, in Africa. So the custodian acts as a cashier, receives money. When somebody wants their money, they're the ones who pay out money. They're also the ones who are responsible for maintaining the records of all the assets or all the investments in that trust, as well as keeping all the documents that prove ownership of the assets in that trust. So that's the second service provider. Then, of course, you have the investment manager or the fund manager who essentially advises the trustee on where the money that has been put into that trust, where that money should go. And because there's money coming in, going out of the trust, and money being made within the trust, that trust, being a separate entity, has to keep accounts. And those accounts, of course, will be signed off by the trustee, but they have to be audited at the end of the year. And then, of course, finally, you have your investor. So just to go a little bit further and compare this trust to a company. When you put money into a company, what do you get in exchange? Shares, and you become a shareholder.
Yeah.
When you put money into these trusts, what do you get in exchange? You get units, and you become a unit holder. And that is why these collective investment schemes, which are formed as trusts, because they issue units, they're called unit trusts. So essentially, all these trusts are the same, irrespective of the founder. What they actually compete on, if I could use that word, is probably service and maybe the investment strategy. So if we take, for example, the money market fund. A money market fund is essentially just a form of a collective investment scheme whose objective is capital preservation. So we have other collective investment schemes whose objectives are growth, they invest in shares, whose objectives are, let's say, income, invest in bonds, others invest in property and that kind of thing. But what investors, and that is the thing that most people don't know, is that the structure is the same, irrespective of the founder. Some founders are big, others are
relatively small.
Yeah, but because of Kenya maturing in terms of the financial sector, so we are seeing an increased number of collective investment schemes being formed as opposed to earlier. So we have quite a number of new schemes that have been formed in the last couple of years.
Yeah. We've spoken about, you've spoken extensively about treasury bills, and there might be somebody who really wants to understand treasury bills to the core, as you've explained the money markets fund. The question around this is, for someone new to treasury bills, what are they and how do they work as a capital preservation tool?
Okay. So a treasury bill is essentially lending to government. And you're lending to government short term. That is 3 months, 6 months, and 12 months.
Yeah.
And let me equate it to, or compare that to your regular fixed deposit. And let me use some numbers just to put some context into it.
Yeah.
So if you went to the bank and you wanted to lend money to the bank in the form of a fixed deposit for 3 months, 6 months, 12 months, and let's say you have 100,000 Kenya shillings.
Yeah. Can I lend 100,000 Kenya shillings to a bank?
This is just an example, using
right.
just for calculation. You can actually.
I wanted to run right now.
You can actually. So let's say you have 100K.
Yeah.
And just for mathematics' sake, the bank agrees to give you 10% as your return or your interest. And let's say you agree with the bank that it's going to be for a period of 1 year. So you will lend them the 10K or the 100,000. At the end of 1 year, they are supposed to give you 10% interest.
Of the 100,000.
Of the 100,000.
So that is the 110,000.
Yeah, so the interest is 10,000. So at the end of the year, they are supposed to give you 110K.
Yeah.
So using that as the basis, let's assume that, of course, interest rates will differ, but let's use 10% again. So suppose you want to lend to government short term, 3 months, 6 months, or 12 months. With a treasury bill, what happens is you decide how much you want to be paid at the end of the period. So in this case, let's assume we say we want to be paid 100,000 at the end of the period. And for mathematics' sake, let's use 10%, and we're saying we want to be paid after 1 year.
Yeah.
So the mathematics, again, is very simple. 10% of 100,000 is 10K. But the mathematics is like this. You want to be paid 100,000 at the end.
Yeah.
So you minus that 10%, you minus that 10,000, so you get 90,000.
Yeah.
So what the government is essentially telling you is, give us 90,000 today, and we will give you 100,000 at the end. However, one way to look at it is that when you're starting off, have that 100,000 today. So when you lend the government that 90K and get 100,000 at the end, remember you started off with 100K, so you give them 90, so you remain with 10K.
Yeah.
So that becomes like your interest. So in a way, you're being
Your interest
paid
has been paid immediately
immediately, as opposed to a bank deposit which is paid at the
end of the year.
So that is simply that, a treasury bill. And of course, the government will take that money
Yeah.
and go and use it for its short-term obligations, rent, salaries, civil servants, that kind of thing. Of course, the bank will take that money and lend it out.
Yeah. They say the government never defaults. But are there any scenarios that the government fails to pay back those treasury bills?
I think in history, I think we only had like 2 defaults worldwide.
Yeah.
But essentially, the government would not default.
Yeah.
Reason being, one of the things that would happen should the government default on paying treasury bills is that the financial sector would essentially
Have crumbled.
collapse.
Yeah.
One of the ways to look at it is that for every probably 100 shillings that you have in your bank account, 80 shillings has been lent out. The other 20 or 30 shillings has essentially been invested. And where has it been invested? It has been invested in treasury bills primarily. So the bank, whatever money that you go and withdraw, essentially has been invested by the bank. The banks, of course, will get paid by government upon maturity every Monday, so that they are liquid. So essentially, if the government should default on that, even you with your little money in the bank, you will not be able to access that cash. So that is just one example. Worst case scenario, the government will just print money and pay you.
After all, they have the machine.
And they will deal with inflation later.
Later.
So when you're talking about these financial instruments of treasury bills, treasury bonds, etc., the government will pay you. They would even just borrow and pay you. Worst case scenario, they just print money.
For the sake of information, which are the 2 countries that defaulted?
One was Russia.
And
I think the other one was Argentina, but that was way back.
Way back.
And it was simply a reason of not being, it was an issue of not being able to pay. It was more of a willingness.
They decided to go that
They just decided
road.
that the previous regime did a bad thing and they're not going to honor those obligations. So those are the 2 I can think of on record, and that is way back. But of course, that caused chaos.
A lot of chaos.
Globally.
Then what happened in Ghana, and I think a European nation, if I'm not wrong, Greece? Would you consider the same as to the government failing to pay its treasury bills? Or that is totally different?
No, that is totally different. One of the things with probably Ghana is the safety with borrowing in local currency is that if things go really wrong, you can
print more local currency
and pay off. But when you borrow in, let's say, in dollars, like in the Eurobond market, you don't have that. You don't have that leeway. So that was a problem now with countries like Ghana.
Ghana and Greece. You spoke about inflation. They will deal with inflation later. The question for that is, what makes treasury bills a no-loss investment, and how do the returns on treasury bills compare to inflation? Because you said if then they're not able to pay, they print money, but then more money in circulation, that means inflation is high. So if I invest in treasury bills, how does my investment compare against inflation?
Typically, what an investor would do, because you always want to get a return that is higher than inflation. So inflation, if inflation, let's say, is 10%, essentially any investment that you make should at least beat that inflation, be it a treasury bill or whatever it is. So your baseline is inflation. Then you add a percentage of return, maybe like 3% typically, if you look at a worldwide perspective. So you have inflation plus 3%. So that is what you decide that when you're going to, let's say, lend money to the government, you say, my return should be inflation plus 3%. So 3% becomes what we call your real return, because the other one has been eaten by inflation. So that 3% is what is actually yours. So any investment, baseline inflation, then you go to treasury bill. Then on top of that, when you're going to, let's say, invest in a fixed deposit, because a fixed deposit is riskier than a treasury bill. Because we essentially say that the treasury bill is like the the base, the standard, the risk-free rate. So when you're thinking about going to the bank, you again gauge what is the treasury bill rate at,
Yeah.
and then you add another premium for the risk.
Yeah.
And that it goes on like that. So usually you start with inflation, then the T-bill. The riskier the investment you add, you keep adding a premium.
Yeah.
The risk premium.
Yeah.
Yeah.
In the most basic way, how can we define inflation and how can we calculate inflation as kawaida investors?
Inflation is simply the rate at which prices of goods and services have evolved over the past 1 year.
Hence the analogy tulikuwa tunanunua mkate 5 bob, sasa tunanunua 50 bob.
Exactly. But now it is calculated on a yearly
basis.
And you don't have to calculate that. That information is public. Every first, second, the Kenya National Bureau of Statistics will release that information and compare that period to the same period a year ago. Yeah. So they will say inflation is at 5%. So that means goods and services have actually risen
in prices.
5%.
Yeah. So then your money, whatever money you earn, must be able to compete with that increase in prices.
Yes. That should be the bare minimum return.
Yeah.
Yeah.
So then that would mean some of us, we are being paid salaries that aren't commensurate to the inflation rate that has been growing.
Yes and no. It just depends on your company policy because we have something. Most corporates have something called COLA, the cost of living adjustment. So what they do is they're trying to adjust the salary
to the cost of living,
which is inflation.
Yeah.
So the rise in the cost of living, which is inflation.
Yeah. All right. Then there is a big boy that rarely is spoken about, and is commercial paper. Commercial paper isn't so commonly discussed as treasury bills or deposits. Can you break it down and what exactly it means and how it works?
Commercial paper works exactly like a treasury bill. The only difference here is that you're lending a corporate entity. Okay? So, when you're lending money to the bank uses it for its onward lending. When you're lending to government, they're using it for their short-term needs. Corporates too also do have their short-term needs, and typically commercial paper, they would come into the market and borrow for typically 3 months or 6 months. To put that into perspective, suppose you have importer of high-end vehicles. So this entity imports the high-end vehicle, probably it's a Land Rover or whatever, or Range Rover, but it'll take him like 3 months to sell it.
That money,
But within those 3 months, the guy needs to be paying salaries, rent, that kind of thing, and that is why they come to borrow short-term, just to cater for their short-term working capital needs. It's just that our economy so far is not that big, so you find commercial paper not too often, too common. But again, also the companies who go and borrow in the market in the form of commercial paper, they usually borrow through advisors, and those advisors typically would approach now the big boys in terms of the fund managers. So they typically would not approach individuals other than maybe high net worth individuals. But of course, a word of caution, as individual investors, it's usually rare for them or for us to go and buy commercial paper directly. One, because of probably the amounts of money that are involved. And remember, investing is all about the future. Okay? We may not have the capacity or even the time to analyze these companies to be comfortable enough that they will pay us in future. So what the regulator has done is that they have essentially said that collective investment schemes, for them to invest in commercial paper as a way to protect the investor, that company must be investment grade. So the chances of them defaulting on that commercial paper are essentially
very limited,
very low. So here you're looking at very strong companies with very strong cash flows.
And would they probably be trading at the Nairobi Stock Exchanges?
Some of those companies do.
Yeah.
But a lot of big companies are also out there and are not really publicly listed, and they do borrow
yeah.
on commercial paper. Though you have companies on the stock exchange who come and do that route. Yeah, they do.
But as you speak about commercial paper, then I'm looking at it. It might be a fighting chance for so many small businesses that we have in the country. If this would be an option for them, because there's so many brilliant businesses that start, but then they get stronghold because of a depth in terms of accessing capital.
It is actually a route.
Yeah.
It's just that now is the time when people are understanding that there's actually this thing called commercial paper, and we can actually get funding from the capital markets.
Yeah.
But it comes also at a cost, because you would have to get what we call a credit rating.
Yeah.
From an organization that has been accredited by, of course, by the Capital Markets Authority. So it comes at a cost in terms of you need to go first, get a credit rating. So this credit rating agency would come and analyze your books, look at the future, and say, yes, this company is actually
worthy to receive the commercial paper.
Yes.
All right. I think, Mr. David, we've been able to extensively cover the products that would fall under a financial preserving. Now, when we come back from the break, I want us to talk about particularly strategy and decision making. What are the strategies and the decisions that you need to make while you are thinking about investing in these money preservation schemes? I hope you're learning a thing or two, because myself, I am already learning a whole lot. When we come back from the break, I know you have questions about making decisions, strategy, but as well risks and the misconceptions around money preservation schemes. That is the conversation we're having.